All right. So as mentioned, uh, this session is all about relative valuation, right? So we have already discussed one of the valuation methodology, which is our DCF valuation, and we saw how intensive it is, right? Starting from getting the historical data to forecasting the data, computing the FCFE and FCFF, getting to the discount rate, and finally getting to the intrinsic value, then performing sensitivity analysis. So it's a very complicated process, not just complicated, it takes a lot of time as well, right? So there's another method. Now, if I ask you that you just tell me as an investor that how do you analyze, how do you pick the stock, right? If you do not have that much time to get into DC evaluation, look into the annual reports or other things. So how do you perform that? So then comes the process of relative valuation. I would just like to give you an example. Let's say if you decide to sell your house, all right, and you don't know how much price you should quote, right? So what is the best way to do that is to conduct a survey. And what you will do in that survey is you will look at the houses which are very similar to yours in terms of size, in terms of the locality, right? In terms of the basic amenities available, the size of, I mean, size, when I say size, basically it's the square foot area size, right? So those are the criteria you will pull to get to the value of that house, right? So you are basically looking at your peers in order to get a ballpark figure of what should be the price of the house. All right. Let's say if there's some other asset which is not that liquid, let's say you have particular painting, right, or any statue which is not very liquid. Very liquid means that it is not somewhere traded, right? It is quite rare, so there is no defined market for the same. Then it will become very difficult in that case, right? It will become very difficult because you do not have any defined peers in that situation, right? So very first thing we need to understand is this relative valuation works better when there's something which is very liquid and which is readily available in the market. There's a well-defined market for the same, because when there'll be more participants involved, you can price things in a better manner. It is both. I mean, this is true for any type of valuation. All right. Even when we discuss the efficient market hypothesis also, so efficient market, the market becomes more efficient when there are more players in the market. Then the price discovery becomes much better. Okay. So relative valuation, first of all, works where there's good amount of liquidity. So we know with the stocks, we have a defined market where we can buy and sell. Right. I'm talking about publicly listed company. Right. For private companies also, we can use the relative valuation approach. Okay. I'll tell you how. So, very first thing is this relative valuation is also referred to as COMS. All right, so comparable COMS or COMS analysis. Right, this is the another name for relative valuation. Basically, it estimates. So, in this case, what we do is we estimate. And again, this also doesn't mean that the value will be 100% accurate. We're just estimating. Okay, it estimates the value of an asset by comparing it with the market values of similar assets. Why we say market value? Because as I discussed, there should be a well-defined market for that particular asset, right? Else it will become very difficult to get to that value. Like as in, I just mentioned in the case of a house. So in case of, let's say you want to sell a house, there's no well-defined market where you can simply sell or buy the house. It's a very disorganized sort of market. All right. And there's a lot of information asymmetry is there, a lot of manipulation is also there with respect to houses. So other noises also comes into picture. All right. So what is the core idea in this case? So if we get to the core idea is basically similar assets are priced similarly. Like, for example, let's say there's a piece of gold, okay, 1 kg of gold. So you know this 1 kg of gold, let's say 24 karat gold is there. So if you go to any country, right? Any country, if you'll go, you don't have to look for the price discovery of anything because that one piece of gold is a standard. Okay. So if it's a standard, you can simply, whatever the price is quoted in India, similar price will be quoted in other countries, America or Middle East or anywhere. Yeah, some difference might be there because of taxation and other supply demand issue thing. But more or less, there will be a difference of almost 10 to 12%. That's it. Rest, everything is same. So it's a same asset for everyone. So it will be priced similarly also, right? And one more thing is the value is relative. The value is relative. What it means, the worth of a company depends on how comparable companies are priced by the market, right? So how the market is, so it is again, it is the core idea is you look at how the market is pricing it. You look at the bigger picture, right? If the market is saying that the share price of this particular stock as per the industry standard should be 100 rupees, but your share is trading at, let's say, 200 rupees. So the market will say that, okay, this is overpriced, right? So there are certain ratios, okay? There are certain ratios like P by E, P price to sales, EV by EBITDA, which are used, okay? These are called multiples. So investors look at these multiples, all right, ratio, which are the ratios of the market value to fundamental earnings. So, I mean, you look at the market value. So it's a ratio of what? So most of the ratio that we'll find on the numerator, you will find the market. I mean, let's say price to earnings. So price is basically what? Price refers to the share price, right? And earnings is what? Earnings is basically I'm referring to per share earning or net income divided by number of shares. All right. So why we rely on this relative valuation so much is that first of all, it is market based. It is market based. So it very well captures the sentiment. It captures the sentiments, right? Second, why we use it is very simple and practical. Right. So what you expect is that the market is fairly pricing. That's the assumption you are making here. The market is fairly pricing that asset. That is why you use this. If someone says, okay, the price to earning of the industry is only flawed, then in that case it won't make any sense. So the market. So here you are trusting the market, right? Because why you're trusting the market? Because a lot of participants are there. A lot of information is already available in the market. Right. It is very simple and practical. It is easy, faster as compared to the other methods, for example, DCF. Right. It's an industry standard. Industry standard. So investment bankers, equity analysts, and portfolio manager, hedge fund managers, they rely heavily on it, right? Because again, it's very easy. It's very easy. Now coming on to what are the limitations of relative valuation? Okay, where it does not work. So the number one limitation it is that subject to market mispricing. What if market is wrong? Subject to market mispricing. So there is some manipulation in the market which is available, right? So if the market is not fairly pricing it, then it doesn't make any sense to use market multiples, right? If peers are overvalued or company will look cheap or fairly priced incorrectly. So if you look at your peers, so in this again, the assumption is the market is fairly pricing. Your peers, basically, when you look at other companies, you believe that those are fairly priced. Those are not overvalued or undervalued. That's the assumption here, right? Second is selection of peer group. Selection of peer group. Now, let's say you are my company is HUL, right? So what are the twins we can find for HUL? So I mean the companies which are exactly similar in structure to HUL, the size, the revenue, the profitability. It is almost very. It's not impossible. It's very difficult, right? So the closest competitor we know is P&G, right? Other competitors is Nestle. Then you have Britannia. Then you have TCPL. Then you have ITC. But if you look each and every company, you'll once you go to the business model, you'll see Nestle, Britannia, they are mostly focused into food and beverages, right? Whereas ITC's main business is tobacco, right? P&G is somewhat very close to HUL. Okay, so these should be your criteria. And it's not just that you need to pick the companies from your own country. Okay, you can pick companies outside India as well. Okay, you can take global peers, but there should be some sort of comparison. I mean, they should be comparable. It should not be that the market capitalization of HUL is, let's say, 1 lakh crore, right? And the other company you are picking is just 1,000 crore. Now, in this case, it won't make any sense. So your peer should, this is the main challenge and limitation of relative valuation, is to find the apt peers. Okay. And one more thing is, like, which I observed, that if you talk about very niche kind of company, let's say any airline company, let's say if you want to value Interglobe or Indigo, then in that case, you'll find that the peers are also very few, right? Most of the peers that you know of in India are what? It is SpiceJet, it is Air India. Okay. That's it. Those are the main two players. I mean, it's a oligopoly kind of market. Very few players are there in the market. So again, there the relative valuation also becomes very difficult. So the result that you will get might be very skewed. Understood? Right. So the selection of peer group is very important, and it is challenging as well at the same time. Next thing is backward looking. So it is very backward looking, right? So we use multiples like trailing 12 months, TTM. Okay, so so again, it uses the historical data. So it is always backward looking rather than forward looking. There are few ratios which are forward looking, for example, PEG ratio, right? That is forward looking because we incorporate the growth aspect as well of the earnings, right? But most of the ratios they are backward looking. So trailing 12 month. Okay, so there's forward looking 12 month as well, but there's trailing 12 months. So the P by E that we talk about, okay, it could be the TTM as well as the forward looking as well. Both is possibilities there, but most of the multiple that we use are trailing. Okay. Right. So now I'm going to discuss few of the multiples which are very used, and which multiple to use where. It's not like that you can use P by E with any company or price to book value with any company. There is a proper set criteria that which multiple to use when. And this is again very testable in the exams. All right. Till here, anyone have any doubt?
No, sir.
Okay. Well. All right. So we'll start one by one. Okay. So the very first multiple, which is price to earning. This is one of the most common multiple you must have heard of. So the formula is, it is price per share over earning per share. How do you compute the earning? It is nothing, net income over number of shares outstanding, right? So another way to write down P by A is also, you can also write down directly market cap over net income. So this is also will give you the same result, because what is market cap? It is the price multiplied by number of shares, whereas it is what? Net income. So if you send this to denominator, it will be price over EPS only, right? Now, when to use this P by E, right? So it is one of the most widely followed, and it reflects how much investors are willing to pay per unit of earning. So it tells how much investors are willing to pay for per unit of earnings, right? When one should use, this is mainly used for stable companies, right? So large cap companies or which are in our Nifty or Sensex index, there we can easily use this P by E. All right. Now let us get into the interpretation. So the very first interpretation is, uh, if the PE is high, what do you mean by high PE? High PE means that the growth expectations, there are a lot of growth expectation, or there is an overvaluation, right? If your company has a high PE as compared to the industry PE, right, then it means that it is overvalued, right? If PE is low, if the PE is low, so high PE again, it means there is a growth expectation. So both the things are there, growth expectation or overvaluation. Why we are saying growth expectation? Because if PE is high, that means you are willing to pay more and more for per unit of earnings. Low PE basically means that there's an undervaluation, right? Or there are risk concern. That means you are not willing to pay more for per unit of earnings. Okay. So if a company is trading at a PE of 20, right, and peers are trading at 15, right? The peers, basically, I'll show you how you get to this peers also. It means that it's a overvalued company. So let me just tell you how basically this works. So let's say this is my company A, and then there are these company X, Y, Z, right? For every company, what we know is for every company, we can get the price. So price of A, price of X, price of Y, and price of Z. This is just an example, right? Similarly, we can also get to the EPS also, EPS of A. Just a minute. One second. All right. So the EPS, earning per share of A, is EPS A. Similarly, for X, it is EPS X, EPS Y, and EPS Z. Right? If you have all these, you can compute the P by E for A, P by E for X, P by E for Y, and P by E for Z. So now you have all this. Now, if I say I have to create the industry P by E, right? So P by E industry, if you have to create, how you can create that? What we can do is we can simply combine or take the average of all the four, right? So we can take the average of all these PE, PEA, PEX, PEY, and PEZ, right? Let's say for A, turn comes out to be 20. Now the average comes out to be, you can use average, you can use median. Okay. So average will make sense if there are no outliers, right? Median will make sense when there are outliers. Okay. And let's say average comes out to be 17. Now you can compare the PE of your company with the PE of industry. All right. Now, based on this, you can say what? So my company's PE is 20, whereas the industry is not expecting that much. Industry is not valuing that much. That means you are overvaluing. So in this case, we can say the A is overvalued. Okay. A is overvalued. One more assumption is PE should be used with companies with positive earnings only, right? If the earnings are negative or loss making, we cannot use PE multiple. That is why it is suggested for mature companies, because mature companies more often than not will have a positive earnings, right?
Sir,
Next
what
comes
do you mean by earnings? मतलब
uh,
the profit
earnings
or
is
what?
earnings is basically net income,
Okay.
income. So net income over number of shares.
Okay.
This is your earning. So it is called earning per share. How much the company is earning, basically. All right.
Okay. Huh.
So PE is used for the companies with positive earnings. I mean, for profit-making companies, not with the loss-making companies. I hope this is clear for PE. Now comes another ratio. If we are not able to use P by E, then which one to use? So another multiple we can use is P by S. So price to sales. So again, in this case also, on the numerator, we will have the market. So price is the market and sales. So sales is basically revenue, and it is revenue per share. Right? Now, P by S should be used, P by S should be used with the companies, for the companies which have negative, income. Because if the company's earning is negative, then in that case, what we can use is we can use the revenue or sales number. And that makes sense. Every company will have a positive revenue, definitely. Right? So this type of multiple is better for companies which are new in the market, which are in the early phase, because we know as the companies move from from nascent stage to maturity stage, they will make positive earnings, but in the initial years it is mostly negative. Okay. So we prefer to use this with the startups, kind of, right? So if we have to value startup, we'll prefer price to sale. Okay, this is clear. Next price multiple that we have is price to book value. This is very important multiple. This is used for banks or financial institution. I mean, especially for those companies which whose assets are financial in nature. Assets are financial in nature, right? For example, banks, mutual fund, AMC, asset management company, insurance-based company. All right. So these companies have uh, assets which are financial in nature. Because what is this basically? Price to book value. Basically, look at this. What's the formula? Again, price per share over book value, right? Once. Okay. So understanding what is book value, first of all, what is book value? How do you compute the book value? So again, book value is, uh, as we know in balance sheet, right? In balance sheet, we have something called uh, shareholders equity, right? So book value basically refers to that equity, right? Shareholders equity. So basically it means is all the face value of the shares. So shareholders equity. So it's the face value of the shares. It actually gives you the net worth of the company as per its balance sheet. Again, understand. Uh, again, the company issued, let's say the company raised 235 crores of equity, worth of equity, right? But if you look at the value of equity now, right, or the market value, it is something somewhere, let's say close to 1 lakh crore, right? So this is the equity they raised, but the market value is this much. So this value, original value of that equity is referred to as the book value, referred to as the book value, but this is the market value. So in our balance sheet on the equity share capital that we have, we always take number of shares multiplied by the face value, not the market value. All right. So this is the difference, right? And now why this is relevant for any bank? Because banks are asset heavy and they're regulated, so their book value of equity is a closer proxy for their actual economic worth. So we, because again, understand, for the banks the assets are financial in nature. We want to look, we want to basically want to see what is the book value of their equity, right? And whatever the value of that equity is, that is the actual value of the bank as well, because there is not much difference in case of bank. So whatever the assets, that will be very, very close to the market value as well. Okay. So banks assets and liabilities are at a very fair value. Okay, so there is not much deviance because assets are financial in nature. Bank's balance sheet consists of mostly of financial assets and liabilities, right? Either they are loans, deposits, or investment. They are regularly marked to market or carried close to fair value. Again, banks assets are always most of the assets, they are marked to market. Basically, what means is, let's say, on a daily basis, the bank actually look at what is the value at the end of the day, because they're financial in nature, right? So if the bank is holding any bond or equity, right, the value changes on a daily basis. So on daily basis, banks see, okay, how much is the loss or how much is the gain. So this is called mark to market, right? So everything is very, very closely linked to the market. That is why we prefer price to book value, right? Understood? I hope this is clear. Okay. All right. So this is price to book, price to sales done. Now, coming on to some enterprise value multiples. Okay. So the very first is the multiple is EV over EBITDA. Okay. Now, same, where to use this? Okay. So what is EV? First of all, EV is enterprise value. And how do we compute the enterprise value? It is the market value of debt plus market value of equity minus cash. So this is how you compute the enterprise value, right? Why we use EV by EBITDA? Because what we are assuming, if we want to nullify the effect of leverage, right? So whatever the debt is there in the balance sheet, so if we want to neutral it, so my company should be neutral to leverage, right? Tax rates, right? So basically, we don't want to look at all these concepts and depreciation policies. Okay, so here we use EV by EBITDA. Okay, it is also very widely used since I told you enterprise value is the value that you pay during a acquisition, right, or a merger, right? So in order to acquire, you pay something called enterprise value. So it is widely used in M&A transaction. Used in M&A transactions, right? Also, we prefer it for capital intensive companies. Capital intensive company like cement industry, metal industry, or power industry, telecom industry. Okay. Similarly, we have EV by EBIT also. Same logic we use for capital intensive manufacturing, airlines, these sort of companies, right? So these are the main ratios which I wanted to discuss. Uh, Again, the benefits, limitations, I've already discussed this now. Okay, so we'll be applying this once we get to the Excel as well. All right, any doubt till here? Okay, if this is clear, we'll quickly jump to Excel now. All right, so before starting with the Excel, let's understand how we'll get all this data, because I told you the one of the most important thing, and it's also the limitation as well, is to get to the peers. What should be my peer set, right? How do we do that? For that, we have a dedicated website. Okay, so we can go to a website called Screener. Okay, so I'll show you from the starting. So you just need to go to this website, Screener. Okay, just put in the name of the company. So in case company is HUL, right? If you'll just scroll down, you'll find something called peer comparison, right? So in this peer comparison, you can see we are given 5 companies. Although you can add more companies, I'll tell you how you can add more companies. In this screener, basically, this is how it is given, right? So for each company, they have given this is CMP is the current market price. This is the PE ratio of all these companies. This is the market cap, dividend yield. Other ratios are also given: debt to equity, share price over price to sales, right? Price to free cash flow, EV by EBITDA. So different multiples are used there. But we know for our company which multiples are more relevant, right? So for our company, I would prefer using price to earning, price to sales, right? If we can also use EV by EBITDA, that is not incorrect, but we will have to create a balance between all these multiples. I'll come to that later, right? You can also edit the column. So if there's any particular thing that you want to see, right? Because I told you that let's say you have 10 companies, not all the 10 companies are very comparable to your original parent company, right? So if you want to filter out companies, how you can do that? You can create headers like market capitalization, right? If you want to look at price to book value, or debt, on the basis of debt, if you want to filter out, you can put in all those parameters. Basic thing is that should be your criteria, how you are filtering out, and you should be able to tell it to anyone, right? So what is the logic that you use to filter out the companies? Understood? So once you have that, okay, you can save all these things and you can simply copy paste this in your Excel. Okay. If you want to, since this list is not exhaustive, okay, because we are not seeing major companies like TCPL, okay, Tata Consumers, Nestle is not available in this. Britannia is not available in this. Even P&G is also not available. So how do you get the complete list? Okay. So one logic is, let's go to another website called Money Control. Okay. So in Money Control, again, put the name of your company, which is HUL, right? If you scroll down, come here and you can see the peers. Okay. So you can see the peers we are seeing is HUL, Godrej, Marico. Now this look much better, right? But we want to see more companies. So what I'll do, I'll just go to see more. So you can see how many, I mean, it's a very long list of companies you have here, right? So even if you are not able to see P by E or other multiples here, what you can get is the list of companies, and you can search each company one by one on Google and get to the P by E ratio. Or if you guys have access to a system called Bloomberg, there also you can directly fetch the peers and the basic multiples. All right. You can also select the sector as well. Okay, so since this is an household and personal product sector, I'll stick to it. If you want to change the sector, right? Let's say if we change to metals and minings. Okay. So you see, none of the companies are comparable because they are the companies from totally different industry. Okay, so it doesn't make any sense. Let's say another company. Let's try another company. Let's say household. Let's take plastic product. You see, there are few companies are there which are comparable to my company, because again, my company is also into packaging, right? But anyways, so the main industry from where my company belong is the personal care. Okay, it's the household and personal products. Now you can also select the criteria. Here the companies are selected on the basis of market cap. You can select the criteria, other criteria, but market cap makes sense. Okay, so I would stick to this only. So here you will get a complete list of all the companies. Okay, once you have all these companies, okay, I'll just go back to our original Excel. What do you? So I already have all the ratios and everything ready. Don't focus on the value as of now. Just focus on the process. How am I doing it? Okay, so quickly just let me get to the industry and peers set. All right, you see, I already selected a list of companies. Okay, so these are my companies. This is the products and operating activity. All these things you can easily get. You can also perform Chat GPT. There also you can get everything. Okay, these are the industries. So you see, the industry should have. It's from the same industry. I mean, beauty, wellness, household, food and beverages, right? And this is a similarity. So you see, for few companies the similarity is very high. For few companies it is quite low, right? So you can just, now this is very subjective, you yourself can decide it. Now other thing that we need is few quantifiable entities. As we what we require is current market price, we need price to earning, EV by EBITDA. All these ratios are also needed, right? So I'll get those ratios as well. But again, do not focus on the current numbers. Now numbers might be different from existing numbers, so just okay. So based on which companies are very, very relevant to my company, I fetched this information, right? So what all information I fetched is, I looked at the current market price. I looked at the outstanding shares. These are definitely in crores. This is the earning per share, right? You see, for these companies, the earning per share is negative. So that means for these companies, when we will be computing price to earning, we cannot use these companies. We'll need to filter it out. That is why we do not have any price to earning multiple here, because for negative earning, we don't, the P by E does not exist. Then we have price to sales. So for these companies, we'll prefer using price to sales. Okay, let's say if I have to just look at the price to earnings. So you can see we have different values, but few values seems very skewed in this case, right? Look at this particular value. It is 116, right? So we need to filter out the companies. So when you will be computing the average, right? When you will be computing the average, I'll prefer removing this company. So I don't want this company in my list if I have to create the industry P by E. How I All right. So what I'll directly do is, or another way is, what we can do is just filter this. Okay, just put a filter. Okay. And in this filter, just remove any outliers if you feel. Okay. So I'll remove the blanks. I'll remove this number. Okay. So other numbers I'll keep, or I'll remove the six also, but because it is very small in that way. Okay. And I'll just simply do an average function and I'll select. Right. And I'll compute the industry P by E. So industry P by E will be average of all these numbers. So you can see the number which I'm getting is 37.6. Understood? So this is the industry P by E. Okay. And what is the P by E for my company? It is 70, right? So for my company, it is 70. The industry P by E is 37.6. So I'll just mention this is industry P by E. Okay. And my case, it is 70. So I can easily say it is what? It is overvalued. Now, if I have to get to the intrinsic value using this P by industry P by E. So how do I do that? So in order to get to the intrinsic value or the share price, how you can compute the share price? I mean, what is the share price basically? It is the intrinsic value. So what I'm trying to find out, what should be the real value? How you can compute the industry PE is basically if you just go back. So in this case, basically, we have the industry P by E, right? What I'm going to do is I'll take this industry P by E and I'll multiply it by the EPS of my company. If you'll do this, you will get the price of your company. So price of my company is nothing but industry P by E multiplied by the EPS of my company. Understood? Similarly, let's say if I have to do this for EV by EBITDA, so what I'll do, I'll take industry EV by EBITDA and multiply it by the EBITDA of my company. So what it will give? It will give EV of my company. And now from this EV, I have to compute the equity value. And how do I do that? From EV, I just need to subtract the debt and add the cash. So this will give me the equity value of my company. Is that so you can see this how we are using the price multiple and how we are using the EV multiple. Right? It's not like that you cannot use EV multiple with this company. You can use it, okay, but you have to convert that EV into equity value, right? And how you do that? You subtract the debt and add back the cash and cash equivalent. All right then. So if I want to know the share price, so what I'll do, I'll take the industry PE and multiply it with the EPS of my company. So how I get to the EPS? So I need to go to my income statement. So this is the current EPS. I mean, this is the current net income. So I'll take this and I'll divide it by 235. Okay, because that is the number of shares outstanding, right? So with the share price comes out to be 1708. Right? And what is the share price now? If you look at the share price, it is somewhere close to 2600, right? So this is the intrinsic share price, right? This is the intrinsic share price. And what is the current market price? Current market price is this value, 2659, right? So we can clearly see it is what? It is overvalued as per the market. All right. But in this case, we are just using the PE, right? What if we use another multiple, right? So we also look at the price to sales. Okay. And let's see what we get from price to sales. So I'll just mention everything here. Okay. So what I'll do, I'll just mention what all things we are getting. So from P by E, we are getting valuation as this number, right? Let's look at what we get from price to sales. Right. So for price to sales, let us get to the price to sales multiple first. So these are the price to sales multiples. Just copy paste these. Okay. Let's look at the other multiples as well. If there's any. All right, so price to sales, as you can see, most of the numbers look very fine to me. Okay, in this case, price to sales, we can also select these two companies as well, for which price to earnings was not available because it was negative in value. Just shift this. Okay. So these are my price to sales. So industry P we already have, right? What we need is industry P by S. Okay, so how do we get that? Right? Okay, so the formula that we'll use is again average. Okay, and we'll select all these because I don't see any big outlier in this case. All right, so based on P by E, we got these values. Okay, let's see what value we get based on P by S. Okay, so same logic we'll use that instead of using the net income, in this case, we'll be using revenue. Okay, so we'll go here, we'll pick this revenue, right? And we'll divide it by 235 because those are the number of shares outstanding. We always look at per share basis. So intrinsic value coming out to be this number, whereas market price is this number. So again, you can see from P by S multiple as well, it is overvalued. So from P by S, what we are getting is 1255. This is the value we are getting from P by S. All right. There are other multiples as mentioned. We can also use EV1. Okay, so I'll show you for EV1 as well. All right. So let's look at the industry. EV by EBITDA. Okay, so EV over. All right. So first, let's get the value of all the EV by EBITDA. Okay. Let's take EV by EBIT only. It doesn't matter much. Okay. Because again, my company is not very capital intensive company. Okay. So let's get EV by EBITDA. So EV over EBIT. Okay. So first thing you can see is there any uh, outlier available here? So for me, I don't think there are many big outliers. So let us consider all these as only. Okay. So what we need is how we'll compute the industry EV by EBIT. So in order to compute the industry EV by, we'll simply take the average of all these values. So average of EV by EBIT, all these numbers. So you can see it is coming out to be 25.7. Now, how do I get to the intrinsic price using EV by? Again, what we'll do, we'll take this number. We'll take this number and first of all, we'll multiply it by the EBIT of my company. So EBITDA, you will use the same, right? In this case, we'll just need to add back the finance cost. My bad. All right, so just get back to it again. So let's remove the EBIT depreciation component. So again, this is what? This is the enterprise value of my company. This is the enterprise value of my company. What we want is the equity value, right? How do we get to the equity value? And again, this is per share basis, so not 365. Let's get to the total. This is the total enterprise value that we have. We need the equity value. So we'll take this enterprise value, okay, and we'll subtract the debt. So go back to the balance sheet, or not the balance sheet, or we can directly go to a schedule and look at the debt as well as from here, right? So you can see for 2025, my total borrowing is somewhat sum of leases plus total borrowings. Okay, so I'll take both this, this. All right, and then we add back the cash. Okay, so we'll go to balance sheet and then we'll add back the cash. So this is my cash and cash equivalents. So we'll add back cash equivalents as well. All right, so you see this is my equity value. Now we need share price. What is the share price? How we can compute that? This is the equity value and divided by the number of shares outstanding, which is 235 crore shares. So 1645 comes out to be the share price. And so I'll just mention from EV over EBIT. What is the value we are getting? Is this value. So you see different approaches gave me different values, right? Now I'll show you the concept of blended valuation. Now, what is blended valuation? Basically, I'm not saying that this value is making sense only or this value is making sense only, but rather we'll try to have a combined number, okay? And not just relative valuation, we'll be also combining our DCF valuation as well. Got it? So let's say, let's combine these values first. So let us use relative. We'll use something called weightage, right? Okay. So let us say I want to assign 50% weightage to my P by E, 25% weightage to my P by S, and 25% weightage to my EV by EBIT. Based on this, what is the value I'm getting? So how I can do that? I'll use a sum product. So based combined value coming out to be 1,579 rupees. Understood? So this is the concept of relative valuation. So via relative valuation, we came up to this value. I hope this is clear. Any doubt, anyone? Right. Again, the main logic is the main limitation, main headache is to get to the good peers. Okay. Once you have the peer set ready, all these numbers you can easily get from Google or anywhere. Okay. That is not the difficult part. Then filtering out the irrelevant numbers. Okay. And then once you have these values, you need to assign some weightage so as to give a combined relative valuation number using different multiples. It's totally up to you. If you want, you can give 100% weightage to PE only and 0% weightage to these two multiples. It's totally up to you, right? Now, one more thing is left, which is called blended valuation, right? This blended valuation is basically what all the equity research reports contain. Blended valuation is not just the combination of relative valuation or DCF. It is a combination of industry estimates as well. All right. So let's say Goldman Sachs. Goldman Sachs will also look at what other banks or financial institutions are giving. It will look at what is Morgan Stanley giving, Bank of America is giving, JP Morgan is giving. Based on it will also assign some weightage to other industry estimates as well. Okay. But for now, we are just taking two valuation technique. First is my DCF and another is my relative valuation. That's it. But in real life, in industry, it is how other companies are valuing that is also considered. Okay. So we'll use blended valuation. So let us say from relative, we are getting number as 1580. All right. Let us see how much we are getting from FCFF. From FCFF, we are getting intrinsic value to be 670, 680. It is very low. Okay. But let's just change it a bit. It's very small. Okay. So let me just increase this to reduce back by 2%. It's by 1%. Okay. So let us say it is coming out to be 1132. Right. So if I have to give a combined blended valuation, how I'll do that? Let us say I'll just take it equal. Okay, so 50% weightage to this methodology, 50% weightage to this methodology. So let us say what is the final valuation which we are getting. Okay, we'll do the sum product again. So you can see it is coming out to be 1356. So this is our final valuation number which we want to give. Right now, if you'll compare it with the current market price of 2659, it is just half of what it is. So this is how we perform the final blended valuation. All these things you can show it in your report that this is from DCF methodology, this is from relative valuation methodology, and this is the blended valuation which we are getting. You can use different types of graphs and everything, whatever you want. I hope this is clear. Any doubt, anyone till here? All right, so if this is done, now we'll start with one last thing, which is the financial ratio analysis. Although everyone is very, very well aware of the financial ratios which are used, I'm just gonna give you an overview what all types of ratios are there, how to use the formula and everything. But all these ratios are available on the, on the company's report as well. So I'll just show it to you. Let's go to this report. Okay, so in this you can see we have something called financial highlights. So if you go to financial highlights, you can see basic ratios which are given. Okay, dividend per share, earning per share. Okay, other than that, you have fixed asset turnover, PAT turnover, return on capital employed, return on net worth. Okay,
Sir,
yeah.
sir, dividend per share as it is written in the above page. So dividend is the total amount which the company will be distributing or what? How to calculate the total
Dividend.
amount the company will be distributing?
I didn't get your question. Dividend per
Sir,
share.
this dividend per share, yeah. So total dividend amount which the company will be disbursing, that will be counted, na? Upon this share.
Yes, exactly. Right.
Oh, okay.
So most of the time for HUL, it gives a lot of dividend. It gives a lot of dividend. So if you see, computed here as well. So you see, look at the dividend paid. So 8,000 was the profit after tax. They paid the dividend as 9,500. So how much? How they are paying so much dividend? More than the profit. So actually they are burning their cash, right? This was very strange. Look at here also. So in this case, they are paying less dividend. Okay, makes sense. You see, retained earnings are very low, right? Because most of the earning they're passing it on to their shareholders itself only, right? Here also you see the earning were 10 crores, but the profit dividend paid was 12,000 crores. So most of the dividend they're passing it on to their shareholders. It's very, very high number. If you can read here as well. Okay. So again, dividend is expressed. Let's say the dividend is coming out to be 20 to 50%. So for 250% or what? So basically, it is always expressed in your face value, right? So if the face value was 1, so that means they are paying 250 rupees per share as dividend. Got it? So
So what can be the reason for this? They're paying more dividends than their profit.
again, this is how big companies operate. So they want to provide it to the shareholders. You can read about it. I'll just show it to you. They are just read this. They have mentioned a lot about this, why they're providing so much dividend. You see, together with the interim dividend of 19 per share and the special dividend on 10. So they have declared dividend twice, one in the middle of the financial year and then at the end. The total dividend payout for the year will be 53 rupees per share, amounting to total payout of 12,453. Again, understand dividend payout is more of a it's a indication. And also, if you look at the promoter holding, because promoters also get this dividend, right? Shareholder data. Look at how many shares do they have actually. So most of the shares are with the Unilever and its associates. I mean, you may think of it that 12,000 crore is given out to the common shareholders, but it's not the case. Look who actually owns most of the shares for HUL. See, you have to deep dive all these things. So shareholding pattern, if you'll see, Unilever and associates hold most of the shares. So 69% of the shares are held by the Unilever only. Okay. So Hindustan Unilever is a subsidy of Unilever. Okay, then you have resident, individual, and others. So this is the common shareholders. You see mutual funds, insurance company, foreign investor, but 60%, 61% of the shares are held by the Unilever and its associates only. Understood? So that is why, I mean, you may think of it, it is passing on to the common shareholders, but no, it's not the case. It is going to the Unilever only. Got it?
Okay, sir.
Again, it's more of for providing it to the stakeholders and shareholders. So it gives a positive message to the shareholders. These are the list of top 10 shareholders other than promoters. You see LIC, how many shares LIC has? 6% almost. Okay, so all this type of data matters. It matters a lot. If you look at multiple companies, you need to look at promoter holding. You need to see how much stakeholding the government has and all those things. Okay. So I'll just directly jump to different types of financial ratios and explain you the analysis of everything. Okay. All right. So starting with the, I'm not going to get into numbers and everything that you have to compute, but just understand the logic. So very first is our liquidity ratios. It tells you how much cash or liquidity a company has to fulfill its short-term obligations. Okay. So current ratio is basically current assets over current liabilities. Quick ratio is basically current assets minus inventories over current liabilities. And cash ratio is simply the cash over the current liabilities. Okay. You don't have to remember the formula of anything. I understand the implication of it. Right. Leverage ratio is basically they are straightforward asset debt to asset ratio. All right. So these are called the leverage ratios, all the solvency ratios. Uh, the very first is to start with, we have debt to equity. Okay. So debt to equity is simply total debt over total equity. If the debt to equity is high, we means there's a higher leverage. The capital structure is very risky. Before only I have discussed that how the capital structure actually matters. Too much leverage or too much debt is very risky for the company, right? Although it brings a lot of value to for the equity shareholders. I'll show you later using the DuPont analysis. But it's not safe. Okay, so there should be a balance between the two. Low basically debt to equity means conservative financing, okay, but may reduce ROE as mentioned. So ROE will reduce in case the leverage goes down. So leverage actually help us to amplify the business because again the cost of debt is always lesser than the equity. Then we also have something called interest coverage ratio. Interest coverage ratio is very critical because it tells you that whether the company has enough capital, enough operating income after deducting all the basic expenses, right? And depreciation. So does the company have that to fulfill its so that they can pay off their interest? Okay. So typically the value of the interest coverage ratio should be pretty high, considered to should be more than 2, okay, on a safer side. If the company have the interest coverage of less than 1, it's a red flag. All right. So interest coverage ratios also you can see this is different company, but I'm just explaining you the ratios. You can compute for your company as well. Then we have some profitability ratio. I'm telling you the main ratios. There are multiple ratios, but let's focus on the main ratios. So very first is the net profit margin. It is simply the net income over sales. Higher the better. Okay. It means that the company is performing good on the bottom line. It is very efficient company. There are few companies which are doing very well on the top end. I mean, top line. They have good amount of revenues and everything, good EBITDA also, but they're failing at the bottom line. So what could be the case? It could be that the companies are not very well efficient. They're not able to manage their taxes. They're not able to manage their finance cost. Those reasons. Okay. So a low margin basically means competitive pressure also, because low margin basically means that you are not able to create a difference. The difference between revenue and expenses is not very much, because you want to survive in the industry somehow. You don't want to dominate the industry. With the companies which have a monopoly or dominance, those companies will have a very good, very healthy profitability. Look at Asian Paints or other companies similar to that, which have the monopoly in the market. Then you have a return on assets. So it is how much the income you are generating based on the assets. So it also tells you the how efficiently you are utilizing those assets, right? Higher the better, definitely. Then comes the return on equity. It is the net income over your equity. Okay, so it is how much return you are providing it to the equity holders, right? So it is net income over equity. Okay. Right. Then we have some efficiency ratios as well. Okay. For example, these turnover ratios. First is the inventory turnover. It is your COGS over the average inventory. So how quickly you are circulating your inventory, right? Higher turnover means higher, it is better. Okay. So you are quickly cycling your inventory. That means the business is good. Okay. It's a fast moving, but again, it depends upon industry to industry. If you look at a FMCG industry, definitely the in the inventory turnover will be high. The days of inventory outstanding will be low. I already told you, because the shelf life is very, very low in case of FMCG as compared to a automotive company. Okay, I mean Hyundai or Maruti Suzuki, there you will have a high inventory turnover ratio, or even bigger, a bigger company like metallurgy based company, or the companies which are into manufacturing capital intensive goods like big machinery, JCB kind of company, okay, or CAT, Caterpillar companies. So there you will see a high inventory turnover. Sorry, a low inventory turnover basically, because the movement of inventory is very small. Then your receivable turnover, already discussed how many. I mean, it is your sales over receivables, right? How quickly your customers are paying back the money. So you are selling things on credit, and how quickly they are giving it back. A company which has a dominance in the market, already discussed this in working capital. A company which has a dominance in the market tend to have a low receivable turnover, right? A company which is I mean, under the competitive pressure, they will keep the receivable turnover high so that they can get more customers. Similar with the asset turnover, it is sales over assets. Okay, so higher turnover means assets are used efficiently. Same logic. I hope this is clear. So these are the basic financial ratios that one needs to understand. Others are very simple. You have gross profitability margin, EBITDA margin, and it makes sense. The higher, the better. One thing, one very important thing one should keep in mind is that it doesn't matter whether these numbers are dipping or increasing. What matters the more is the consistency, right? If for one particular year you see a spike in your profitability ratios, and another year there's a dip, that is not considered to be a healthy sign. Okay, there should be a consistency, or there should be a gradual movement in these ratios, right? Any sudden or sporadic jump is always a red flag to a financial analyst. Understood? Right? So bottom line is liquidity ratios, they tell you can we pay bills tomorrow. Okay, it tells you that in the emergency situation, do we have the enough buffer? Solvency ratio, can we survive long-term debt obligation, which is governed by your interest coverage ratio, debt equity ratio, debt to asset ratio, right? Then we have profitability. How are we generating returns, and how healthy are we? Then we have efficiency, basically things like asset turnover, receivable turnover, all those things. How well are we using the resources, right? How well we are quickly circulating the stuff. And then the last ratios are also called market ratios, which we just discussed, which is price to earnings, price to sales, all those type of ratio, which tells us how the market is looking at us. Okay, so if the price to earning is high or price to sales is high, that means the market is expecting more from us. We need to deliver. Understood, everyone? Guys, is this clear? So you guys have to perform the basic analysis of these ratios, which I just mentioned. You can add or remove other ratios. Now, these are the bare minimum that one needs to put in. You can add, remove other ratios as well as you wish. Okay. Don't remove, just keep. It is better if you analyze in more depth or add more ratios, but those ratios should be relevant. Okay. The last thing which I wanted to discuss is called the DuPont analysis, and this is also very important. So just uh, let's see the screen. Right. All right. So let's quickly understand DuPont analysis. Okay. So let's just look into the formula. So basically, we know return on equity is given by net income over equity. Right. We can break down this formula into three components. What are those three components? So ROE, it is basically we can break it down into uh, net income. So we'll take this net income, okay, and we'll divide it by sales, right? And at the same time multiply it by sales, okay. Similarly, for equity also, and here we'll write down equity. We'll multiply it by total assets, and we'll divide it also by total assets. Right. So basically, nothing is changing in the formula, just the how you are expressing it. So now, if we can say it that ROE is driven by three components. First is net profit margin multiplied by asset turnover and equity multiplier. Right. This is also called leverage. Okay. There's another level to this. There's a three formulas are using. We can also use five formulas, but that is not needed for now. What it tells us that how much this ROE, what is driving this ROE, whether this is coming from the operational efficiency. Okay, so this is my operational efficiency. Oh, sorry. This is my asset use efficiency. So this is my asset use efficiency. How well I'm utilizing my asset, or it is coming from operational efficiency. How well I'm keeping the expenses low, revenues high. Okay. Or it is driven by the leverage, how much debt we have. So what is actually driving my ROE, which is return on equity? Understood? So a company with low margin but high asset turnover can still have a good ROE. So although if the net profit margin is low, and if this is high, then also my ROE can be high. The company can also boost its ROE artificially. So artificial boosting can also be done. Okay, how? By increasing the leverage. So this is also what company does to make their ROE look lucrative to the investors. They increase the leverage, right? That means increasing the leverage basically means increasing the debt. See, if the leverage is increasing, basically total assets are increasing. How the total assets will increase? If you will increase the liability. Look it from a balance sheet perspective. The liability is increasing, so the total assets are increasing. Or if the equity is decreasing, how the equity can decrease? If the liabilities are increasing, because equity plus liability equal to assets, right? So from that equation, we can understand this. So artificially a company can, so these things cannot be changed artificially, but leverage is something we can artificially pump it up. Okay, so this will lead to the increase in your ROE. Okay, so you can perform this DuPont analysis for your company and you can see what is actually driving it, and mention this thing in your financial analysis component in the report. All right, so that's all from my side.